Good afternoon, everyone, and welcome to the launch of our white paper, Scaling Up Institutional Investment for Place-Based Impact. We're really pleased you could join us this afternoon. I'm Jamie Broderick, and I'm a director at the Impact Investing Institute and was closely involved in this research project. My background is in asset and wealth management. I was CEO of JP Morgan Asset Management Europe, and then head of UBS Wealth Management in the UK. The Place-Based Impact Investing project was set up to explore how to scale up institutional investment into opportunities that would connect capital to place. Just so you can visualize it, it's things like social and affordable housing, small business finance, clean energy, infrastructure, and regeneration of towns and cities, but with a specific connection with the development needs of a community. Place-based inequalities are more extreme in the UK than in many comparable economies, and they've persisted for generations. But more recently, Brexit and then the pandemic have moved this problem to center stage. The costs of the leveling up agenda are expected to reach £1 trillion or even several trillion over the next 10 years. So we think there's a clear need for private capital to be mobilized alongside public investment. We're grateful for the financial support for this research, which came from the Department of Digital, Culture, Media and Sport, the City of London Corporation, and Big Society Capital. Now, this is an hour-long session, and we'd like to spend about half an hour, maybe a bit more, outlining the report and its conclusions, and then move to your questions. So please submit your questions using the Q&A feature at the bottom of your Zoom screen. And there's no need to wait until the end. Feel free to submit them whenever the questions come to you. You can also upvote other people's questions if they're of particular interest. Just to note, the session is being recorded and you'll be able to view it on the Impact Investing Institute's website after the event. The project was led by The Good Economy, the Impact Investing Institute, and Pensions for Purpose. I'm pleased to welcome 3 senior members of the research team from The Good Economy for the start of this afternoon's discussion. They are Sarah Forster, co-founder and CEO of The Good Economy, Mark Hepworth, co-founder and director of research and policy at The Good Economy, and Paul Stanworth, CIO at 777 Partners and principal advisor to The Good Economy. They will highlight the key findings and recommendations for us. Mark, can we start with you?
Thank you, Jamie. And good afternoon, everybody. I think Jamie's set out the context in which we're working quite well. The report is really addressed to a very big question, which is how can we mobilize institutional capital? How can we get institutional investors to contribute more to meeting the challenge of leveling up and building back better? We know this is a considerable challenge. Can I go to the next slide, please? Thank you. We know this is a considerable challenge. There's a social consensus around it. A man on the street, 70% of people believe that tackling place-based inequalities is a high priority. And we also heard from Her Majesty herself, who talked about leveling up. I never thought I'd see the day that we'd get that far with leveling up and actually tackling regional and urban disparities in the country. But we are at least all on the same page, and being on the same page has an advantage because it does actually invite people, including investors, to work out how do we do this. And in this report, what we're doing is we're suggesting and we're putting forward a place-based impact investing approach to leveling up and building back better. This is our definition of place-based impact investment. We see this as a third engine, a much needed third engine, the other 2 engines being public investment and social investment. These are also active areas of place-based impact investment. So what we're looking for here is how do we mobilize institutional capital, commercial money, private capital to help us build back better. So that's what the report is about. And it is specifically a how to do report. It's really how do we make that happen. So the model that we present in the report has been essentially worked on with a lot of people, stakeholders from different sectors, markets and geographies, to say how can we actually make this happen. Can we go to the next slide, please? So this is our current picture that Jamie described. Those maps on the right show those areas of the country which have been hardest hit by COVID, and also which we continue to refer to as left behind communities. These are the areas of the country where building back better is going to take much more time and far more resources. So if we're interested, if investors are interested in building back better, they need to adopt a place-based approach. A place-based approach means actually ensuring that investment meets the needs and priorities of these communities, working closely alongside these communities so that at the end we can see that investment has actually worked for the communities themselves, and that this requires essentially looking at the whole country through a geographical lens. And in that sense, that is probably quite new to most investors who are used to sitting in London and thinking globally. We're thinking locally. Our focus as a practical context, we're looking at the local government pension scheme. So the report focuses on the local government pension scheme. Why? Because it has a place-based geography to it. There are 98 funds across the country. There are 8 pools, and also they're big investors, £326 billion. And we're also seeing positive signs of interest and activity in the local government pension scheme sector. And what we're really interested in is what can you learn from it, and how can you scale up this activity? So that's really what it's about. And the question is a good one to ask, because if we can aspirationally at least say we can get 5% of that 326 billion moved through place-based impact investment, that's 16 billion for building up better. If we can extend that to the pension fund sector across the UK more generally, using place-based impact investment models and driving it forward, we could release close to 200 billion towards building back better. And that's the order of financial resources we're going to need. So the question is worth answering. And that's why that's what's driven the project along. The belief that somehow we can do this. I'm sure we can do it. So go to the next slide, please. So we've created a model of place-based impact investing, which actually sets out for people. This is the kind of way we see it actually working, that at the foundation stone is our places. These can be entire Midlands and Northern powerhouses. They can be city regions. They can be combined authorities and local authorities, wherever economic development policy is being made. At the top in the capstone, we have investors, but particularly investors who are looking to make a social economic impact, to actually do things, whether it's climate change, equality, and just generally aiming more being led by SDGs and inclusive and sustainable development. They want to make an impact. What holds it together are 5 pillars. Here we've got housing, SME finance, clean energy, infrastructure, and regeneration. These pillars they are dual structures. On the one hand, they're sectors where economic development is happening and where economic development is prioritized. And on the other hand, they're also sectors for investors themselves. So what we're seeing there is in those sectors, by driving investment into those sectors and creating multiplier effects and linkages across these areas, grounding them in place, is we will create a place-based impact investing model, which we think will work to build back better place by place across the country. Next slide, please. Well, we need everybody to work together to make this happen, but we're positive. There's lots of positive signs here. For example, on the left-hand side, the members of pension funds, if they are to follow what's going on in the public, what the general public is, there's an interest in their savings and investments being used for helpful reasons as opposed to harmful reasons. There's more interest in impact. LGPS funds themselves, the middle of this system, are actually moving towards ESG integration, and they're being more SDG-led, conscious and aware. We have pension pools that are building up muscle and can allow us more aggregated, more collective efforts. We have fund managers who are increasingly in impact. out of this system, what we're hoping is we get place-based impact investments which feed back into the regions where those investments emanated from. So that's the model. And with that, I think I'll hand over to Paul.
Thank you. Well, thank you, Mark. On this next slide, if we can move to the next slide, we took this economic theory, which Mark was talking about, and we turned our attention to the issue of actual investment returns versus risks, measuring risk as investment volatility, really in line with generally accepted portfolio theory. And we analyzed the returns which closely match the sectors in the place-based pillars that Mark has just been talking about. Firstly, we did this by reference to a recent report by the Pension and Investment Research Consultants, which found that over the last 10 years, the global sectors of property and alternatives exhibited far more attractive risk-return trade-offs than equities, even though equities represent 55% of assets. They also found, unsurprisingly, that the allocations into property and alternatives is increasing, but importantly, the returns depend much more on the manager. However, our focus is on the UK, and so we dug deeper into UK-only funds, and we searched public markets and private markets which operated in these sectors. And we found that the universe of assets with good data was unfortunately disappointingly small, with only around 140 funds and companies to include. However, out of that universe, the results that we looked at mirrored the PERC report. And in all cases, the risk return from public markets were more attractive than the FTSE 100 over the similar timeframes. Private markets were even more attractive on this basis. So we concluded that far from inhibiting returns, the PBI sectors were actually more attractive than mainstream sectors. And many of these assets are cash flow generative and countercyclical, which is really valuable for a portfolio of pension assets. And we would have expected, based on this section of the report, that these assets would be prominent in pension funds. Next slide, please. So we set about to look at the pension funds, and we reviewed where assets were actually sat within the LGPS portfolios. Taking the sector definitions from our financial analysis, we broke down all the LGPS funds into the PBI sectors and reviewed their participation into global sectors, national sectors, and regional or local sectors. And we found that their total into these sectors to be 7.7 billion, which only represents 2.4% of assets. Contrast this with equities, generally around 175 billion, much of which is overseas equities. And in addition, the amount which was either regional or local was a mere 300 million pounds, or 0.1 of 1% of funds. Those that were investing were predominantly the largest pension funds in the north of England and in Scotland. Then we reviewed the funds for their intentionality via their communications. As a background, the local government pension scheme is made up of 98 individual pension funds, ranging from large funds such as Greater Manchester with over 20 billion of assets, to much smaller funds such as the London boroughs with less than £500 million. Each has a report, and we reviewed a representative sample of 50 annual reports. We found around 12% showed clear intentionality to invest in the UK at a regional, national, or local level. And this was clustered around the very largest and very active funds. And the map shows the results of this analysis. In summary, we found that despite the good returns highlighted on the previous slides, the allocations into PBI sectors was relatively low, and the intentionality to invest in these sectors was lower still. So we embarked on a set of stakeholder interviews around the ecosystem that Mark outlined. These were interviews with investors, local authorities, fund managers, and consultants. The key findings are shown in the table on this slide. We also highlight some of the solutions that were suggested. Firstly, there are many agendas driving the themes in the ecosystems, in particular ESG, and E being the most prominent. PBI is in the S category, and it simply doesn't get as much airtime. However, many suggested that as a consequence of COVID, that the social inequalities and place-based inequalities have become much more important and is an area that investors can influence. Furthermore, global investing was sought for diversification purposes. However, the contracyclical and superior returns that are contrasted with an increasingly synchronized equity market suggested that the PBI sectors should get more attention. The second area that came up was conflicts of interest. This issue is about maintaining clear barrier between the fiduciary responsibilities of the funds and the political aims of the local authorities. And there was great sensitivity around this topic. However, we found that those funds that were most active had successfully created robust governance frameworks to mitigate this risk. Thirdly, it was a question of bandwidth. It was clear that those who were active were supported by large teams, spent more time on investment, and valued spending on experienced resources. The models were either in-house or sponsored partners or pooling resources such as the new pension pooled funds. And these models are characterized in our report as build, buy, or borrow. But it was clear that the rewards followed spending and operational capability. And finally, there was a view that there were few investable opportunities. However, we contrasted this with many funds attempting launches of perfectly investable propositions. The issue seems that only the largest fund managers were able to get good coverage of LGPS funds, and therefore the system of fund selection simply worked against the smaller specialist managers that were prevalent in the PBI space. Overall, therefore, it appeared that there were no hard barriers. It seemed simply that bridging the investors to opportunities was more logistical and a challenge to the status quo of low-cost asset management and consultant-led selection. And we concluded that it was entirely feasible that this sector can grow significantly. In fact, there are some great models of place-based investing across the UK, and we highlighted several in detail in the report, and many of them are on this map as well. Active funds have taken a variety of approaches to meet this challenge. This includes direct investing, where the funds build their own teams and have gained confidence and experience to invest in projects in their own right. Some have partnered with experienced developers and fund managers in a co-investment model. Here, the governance of the investment is shared. However, the investment itself is not conducted by the LGPS fund, but by the lead partner. And in return, they share the investment returns. And finally, some have engaged with specialist fund managers, successfully creating mandates to meet the investment and social needs and aims of the LGPS fund. And the trend is very encouraging, and more funds are coming forward to be considered. The aim of our paper was always to assist in accelerating this investment trend, which we saw as small but growing. And it's not about reinventing a wheel. And we therefore turned our attention to what could be done to nudge forward the pace of PBI investment. And then I'll hand over to Sarah for the final section of the report to conclude our work on impact and measurement and also the paper's recommendations.
Great. Thank you, Paul, and thank you everyone for dialing in. So as Paul said, there is place-based investment happening across the country, but what we're particularly interested in is investments that are sort of embedded in place and clearly deliver benefits for local people and places. And we see impact measurement, management and reporting as critical to this agenda. We sort of described it in the report as the golden thread for stakeholder collaboration. Because what we're saying is, good place-based impact investing absolutely needs collaboration and trusted relationships across the financial sector, the local authorities, local organizations, and often, frankly, there are silos and lack of trust between these sectors, which we experience very much in our work at the Good Economy. So good impact reporting can bring transparency to how money is invested, and also accountability, not just to shareholders on financial returns, but to all stakeholders on impact performance. So what we did under the project is we actually formed a working group comprising local authority representatives, fund managers, and pension funds representatives to see if we could develop a common, consistent, and credible approach to impact reporting. There was a definite interest in this, and real sense that there's a lot of talk about ESG and impact reporting, but a sense that also it can be complex, and how could we develop a sort of simple approach that would work for this ecosystem. So underpinning the approach were sort of three principles. One is we didn't want to reinvent the wheel, so we looked to align the approach with international and UK standards. Specifically, it aligns with the Impact Management Project, which some of you may have heard about, and also the National TOMS framework, which is used by local government in terms of looking at how to sort of measure outcomes. The second key is that we want this to be embedded in place. Places are very different, be they rural areas, urban areas, cities, so the context of place really matters. So, where is this impact creating? What outcomes? Who benefits? What additionality is the investor bringing? And also, what are the risks of negative impacts to local communities, and how can they be mitigated? And finally, we wanted the impact reporting approach to be useful and practical, and particularly that it would enable pension funds to communicate with their members, who's ultimately, it's their money that they're managing. So if we go to the next slide, what we've come up with a basic approach which has common objectives and KPIs. And just to say, we're not saying these pillars represent all pillars, but they're 5 pillars that we've highlighted. But the point here is that these objectives are absolutely objectives that you will see defined in local strategic development plans, and they also work for investors. So, increasing the supply of genuinely affordable housing is a priority in every area in this country. SME finance, all places recognize that it's the small businesses that really are the backbone of local economies. And these are across all sectors, the creative industries, health, technology, clean energy, the transition agenda is so huge. So all of these objectives are absolutely core development objectives locally, but they can also be investment objectives. And then on the right, what you see is really, we came up with a sort of one-page template that could potentially be put in an annual report of pension funds, just showing, okay, where is this investment taking place within the local geography, in what sectors, and some headline indicators to sort of demonstrate results. So there's more on that in the report. And if you're interested, we do want to develop that further. So in a collaborative way with practitioners. So do get them, reach out if you're interested. Finally, our recommendations. So if we could go to the next slide. Yes, we've set out in the report 5 areas that we see as sort of critical to scaling up place-based impact investing. So the first is raising awareness. I think what we knew but became really evident and in a way quite shocking doing this report is that actually, pension funds and other institutional investors allocate capital to the global capital markets, to listed companies and funds, and really with no full consideration about whether or not there would be investment opportunities in closer to home in the UK that would deliver the same returns and diversification that they need, but also bring benefits to people. And we want to change this investment paradigm. That's what this is about. It's about changing hearts and minds. So we absolutely want to get PBI onto the agenda of pension fund investment committees. We want consultants to start looking at investment funds that are specialists in this area. And actually, we believe the demand is there, so they're worth research. And we want local authorities and other stakeholders to start to see where private capital could play a role in delivering local projects and really backing local economies. Second, though, we recognize that across the ecosystem, we need not just more focus, but more capacity. All of these areas require some sort of technical expertise, due diligence, and appraise projects and opportunities. So that sort of capacity building is a key area. and one where potentially there's need for sort of technical assistance funding, we believe, particularly at the local government level. Third is impact reporting. I won't go back to that, but that is, critical for really, us all knowing how is this money invested and demonstrating sort of results. The next is connecting investors to opportunities. As Paul highlighted, we've actually found, many viable investment opportunities, from, investment funds in creative businesses to SME funds, backing businesses in the Northeast, to affordable housing funds. And, what we heard time and time again is that they couldn't raise capital from pension funds, from institutional investors in the UK. In fact, some of them found it easier to raise foreign investment than they did UK investment. At the same time, we hear from institutional investors they can't find the opportunities. So clearly there's need for information flows. And here we actually think sort of digital platforms could play a role in helping with origination and connecting capital to opportunities. And finally, scaling up requires really developing investment funds and products that are at the scale and quality that they meet institutional investment requirements. We want to bring, the big guns into this place. We know that Legal & General already has put their balance sheet to work. M&G, I'm hoping are listening in. We've talked to them. They're interested in this agenda. But equally, we know that some of the the organizations that have the highest local impact are the smaller fund managers and projects. So we need to find ways to get capital into those more regional and local organizations. So with that, thank you for listening. We can already see there's lots of questions, but I think just to end with saying we think there's a real window of opportunity right now for this agenda. And with that, I'll pass back to Jamie. Thank you.
Thank you, Sarah. And thanks to all three of you for that really efficient description of a really substantial piece of work. At this point, I'd like to invite my colleague from the Impact Investing Institute, Sarah Teacher, to talk to us about what we anticipate will happen next in this project to promote place-based impact investing. Sarah is an executive director at the Institute with an extensive background in sustainability and social impact. Sarah?
Hi there, and thank you so much to the Good Economy for their remarks. I'll be talking about what we at the Institute will do to take this work forward in the next year. We're very grateful for the 2021-2022 support from DCMS and the City of London Corporation in particular to help us strengthen and refine this place-based approach to impact investing. And Sarah has already outlined the five main areas that we'll be looking to deepen, but to elaborate a bit more. Sarah mentioned our first priority of raising awareness across this year, drawing on the model and experience described in the white paper. So we'll be working across a broad range of stakeholders from around the country. We'll be sharing this approach with further local government pension schemes, other pension schemes and institutional investors, investment consultants, central government, local authorities, fund managers, banks, and public finance institutions like the new UK Infrastructure Bank. On that capacity point, to increase competency in place-based impact investing, we will improve access to information. And the Impact Investing Institute has a fantastic learning hub, which was cited by Forbes as one of the best repositories of impact investing information online. We'll be building that out to showcase the content of the white paper, making the data and the case studies yet more engaging and accessible, and supplementing it with key resources from aligned initiatives and partners. We'll also be working with Pensions for Purpose and other partners to expand the Impact Investing Adopters Forum there to host helpful information on place to investors. And as Sarah so eloquently outlined in this report, the Good Economy have proposed a draft outline reporting framework. We want to further drive development and adoption of reporting in this framework across the year. And the Good Economy will be piloting this, encouraging institutional investors, fund managers, and local authorities to join current working groups. We will also encourage LGPS funds, aligned fund managers and others institutional investors to start to map the geography of their UK investments to provide greater transparency as to where capital flows in the UK. As was often cited across the project, improving information exchange and origination between investors and place-based opportunities could be a significant accelerator of funds better flowing to regional regeneration. And this year, we at the Institute will be carrying out and making available a review of existing origination platforms that could help facilitate increased investment in regional regeneration, both engaging with existing investor platforms with the aim of utilizing One for Place, or if current platforms don't deliver what's needed, explore scoping out a new dedicated platform and solving that problem. And finally, the Institute wants to encourage and mobilize big pools of capital into this approach to impact investing. One of the main ways of so doing concretely is to support and increase the number of place-based impact investing financing vehicles extant in the UK. And again, across this year, we will deliver an implementation roadmap for the creation of a place-based impact investment vehicle, which we hope would leverage significant amounts of capital from a range of private investors to support social and economic renewal in disadvantaged communities. So it's going to be a busy year. And as you can hear from the Good Economy's remarks and Jamie and mine, one marked by engagement and partnership and collaboration. And we would love for you to be part of this movement. So please do be in touch if you will join us in the next chapter of our work. Thanks so much.
Thank you, Sarah. Thanks very much for that. And now I'd like to invite all the speakers back on stage. And now we'd be adding Karen Shackleton, Chair and Founder of Pensions for Purpose, one of the project's 3 sponsors. Welcome, Karen. And maybe we could actually start out with a question for you. You work extensively with pension funds. What are you observing? Are pension funds considering environmental impact, social impact, and place-based impact as distinct investment opportunities? How is their thinking evolving? How's the dialogue evolving? Give us
It's really been really interesting to see how the dialogue has changed over the past couple of years. I think initially it was all about, I want to get this impact, and it's a very specific niche area. Now, and particularly the pandemic, I think has encouraged pension funds to think in this way. There's more of a holistic view. And so they've been thinking about their investment beliefs, thinking about what they want their priorities to be. And okay, if they go for an environmental fund, something in renewable energy, they also want to see the social impact coming through, and they want evidence of how that investment will impact positively on the community, local economy. Similarly, if they want to try and invest in affordable housing, for example, having a social impact being the driver for that decision, then they also want evidence that the housing itself will be thinking about renewable energy and thinking about its carbon footprint. So it's becoming a more holistic assessment with something driving the decision, but taking all types of impact into consideration.
That's great. Thank you, Karen. I'm going to go to some of the other questions that we've received. I'm going to go with the wisdom of crowds. The question people are most interested in is the following. How will communities be empowered to influence the projects funded by institutional investment, both in terms of which projects are funded and how they come forward? I'm going to toss that out to Mark, but you can punt it to any of your colleagues. But let's start with you. Just got to find that mute button.
Thanks, Jamie. Yeah, I think this is an important question. I think we have what we're talking about, and I talked about that 3-engine plane, and we talked about public investment, we talked about social investment, and now we're talking about private investment. And what we do need, I think, is coordination at the local level. So with this place-based impact model that we've created, what we haven't talked about, but to some extent it's implicit, is that what we need a way of coordinating what's going to happen at the local level. Very simply, because we want people to become engaged. We want those objectives become what actually something that the community believes in. We want to work with local authorities, but we also want to work with a range of groups locally. And generally what you find, strangely enough, is that there will be projects, in each area that people are already interested in moving along. So last night, I did a keynote address to the Institute for Economic Development. And what was interesting was, even though it was happy hour, and I think probably everybody had gone home by then, is what I did get this morning in my email is a whole rash of emails from people all over the country who have got economic development projects which they'd like to move along, and which they were interested in to what extent do we get this money in, and they were very interested in the potential of the local government pension schemes also being participants in that process. So I do think that I've worked for 30 years across this country on economic development, and there is a great deal of infrastructure at the local level and ways of actually involving people in these schemes. There are economic recovery boards right across the country. There are community wealth building infrastructure across the country. There's various infrastructure for getting people involved. So, but I do think, and I think it's something that Paul and I were talking about the other day in Chiswick. Paul, do you want to add to what I've just said? But it was this issue of how do you coordinate these kinds of investment opportunities?
Yeah, it is a really critical question. And I think, you know, Jamie, that the way that you brought it forward around the inclusiveness of the community in terms of, you know, what needs to be prioritized for the area. The challenge that we highlighted it within our different suggestions is there needs to be some sort of focal point where the investment actually happens as well. And these things there needs to be engagement in terms of what the priorities are. But at some point that needs to come together into, you know, organizationally into an investment that can be made by a fund manager, really, or investment department. And I think that's the challenge, is bringing together an inclusive approach to what's required in a local development plan, and then prioritizing it so that when there's engagement with the investment community, it's in a way that they're able to interact. And I think that was key. That was a key thread in our thoughts about how to organize the way that this operates at the back end of the presentation.
Well, that's an interesting point, Paul, because one of the observations made in the chat is how do you define what the pillars are if you haven't yet consulted the community? And I think you've sort of intimated that when you say it's got to be investable. So you have to find something where there's an intersection of community need and investable, because, I mean, is that what you're saying? Is that?
Yeah, and I think it's a really critical question, Jamie, because I think, you know, we see often that, you know, the real success that Manchester's happened, and it's got an economic development that is very positive, and it's drawing in capital. And there are other areas that the economics are not working. And I think that's why, in order for the funds to be able to tick the fiduciary box, not just the sort of social purpose box, but the fiduciary box, that they've got the returns that they need for that type of risk, that there's a place for government to partner in making those investments either get the returns that are required or making them less risky. And I think we've seen this in a number of areas. So the coordination is not so much just with the community, but it's to what extent does, you know, all the government funding programs become part and coordinated with that to make the investments either lower risk or investable for the investment community. And I think that this is why we come back again and again. The coordination of this is really, really vital. Otherwise, it can have, you know, unmanageable parties all pushing different directions. So I think the areas, and I think particularly Mark was talking about it, the idea about the levelling up agenda, it's critical that includes where the government's going to put their money in as long as private money to make it an investable proposition.
So you're saying, I mean, Paul, you're saying that not everything that's a community need can be invested by fiduciary investors like pension funds.
I think that is the case. I think there are some, SME finance is one that's relatively straightforward, but I think there are some other sectors that seem to be, much more around public funding out of those three engines that Mark was talking about. And
Yeah.
what we're trying to do is highlight the ones that most naturally sit in the investor space.
Okay, real quick, Mark, because I want to move to the next
Just
question.
come back on that quickly, Jamie. As you know, that when we first put the model out with the 5 pillars, is that we got a reaction from some of the big rural counties. And what we said at that time was that there can be a 6th pillar. We put 5 pillars there, which is my experience, that's everywhere across the country. But a 6th pillar, if you're a county, if you're a rural area, like south of Scotland, where I was working last year, is you would have agriculture and forestry in there as another pillar.
Okay.
In terms of the priorities that Paul's talking about, we are not saying that this form of capital and these types of projects take you 100% of the way, which is why I said we're not a single propeller plane here, place-based impact investing. We're working alongside government money. We're working alongside social investors. That is important to understand in presenting what we're saying, is that we see this very much as bringing in new capital, new interest from the private sector.
Okay, let's move to a different question. This one from Phil Higham, which a lot of people seem interested in. I'd be interested to see or hear about some examples of good place-based impact investment, either in the UK or elsewhere, with particular reference to outcomes and benefits that have accrued to all stakeholders. Any takers there? Sarah, go ahead.
Sure. I mean, Phil, we try to highlight some examples in the report, and as sort of Mark and Paul have did, we're looking specifically investments that have raised institutional capital. But I think what's interesting is within that, there are ranging from, so Nottinghamshire Community Energy, I think, is a good example of a sort of a community energy company that is locally owned. The pension fund has co-invested along with local community shareholders. They're getting return, but also there's a return to the community and a fund that funds community projects. So you really see that sort of circular revenue flow. At the other end of the scale, we've got Greencoat, a listed investment trust that's absolutely raised capital at scale, investing in clean energy, also bringing benefits. There's a range of funds and direct projects that we've highlighted. I think what's critical, though, is, right now, most of those don't really measure the extent to which they deliver outcomes and for whom, and any, potential negative risks. And this is why we'd like to see the sort of impact reporting become core to investing. So alongside the financial performance, we can really track those, local benefits.
Okay, great. And does social housing work in this context? Let me ask, because you come from that space.
Yeah, the 2 areas where we're seeing a real growth in funds are clean energy and affordable housing. And within social and affordable housing, you've got funds such as resident.
Can I tap Sarah Teacher for this?
Sure. Yeah.
Having 2 Sarahs.
Sorry, 2 Sarahs.
Because you come from the real estate space, so what's your observation on social housing, social and affordable housing?
Oh, on the role that it can play in this area. Well, I think we're developing work on the investment case for social and affordable housing, and I think we see again and again that it can play a really powerful role within investor portfolios, but it can also play a really powerful role in solving the affordability crisis. So I think it's a perfect example of where private capital can come in, and increasingly is coming in, delivering a really important social impact for the country. Great,
thanks for that. The next question is one for Karen, I think, and it's really interesting to me, and it's about consultants, particularly in the pension context. So consultants can be reluctant to undertake due diligence on a place-based impact investment fund unless their client specifically instructs them to do this. Yet many pension funds look to their consultants to bring new investment opportunities to their attention. So it feels like a circular problem. So how can this challenge be mitigated?
Well, it's absolutely a chicken and egg problem. So which is going to come first? Is the consultant going to be proactive, which is what the pension fund wants them to be, and research some of these new funds, or are they going to be waiting for the client to instruct them so that they don't spend a lot of time and effort where there's no demand? And I think perhaps one solution would be to do what I would call a light touch due diligence exercise, so that they're aware of the funds that are out there and they can bring them to the pension fund's attention. But the pension fund in turn has to recognise that that is a light touch due diligence. And if they're going to proceed, they will need to do more in-depth due diligence. And that may then mean that the consultant changes their mind and says, actually, now we've gone into the detail, this isn't suitable for your pension fund. But I think another suggestion I'd make is to, many local authority pension funds have independent advisors. And we've noticed on the Pensions for Purpose platform that the independent advisors are actually hungry to learn about impact investment. A lot of the events that we've run have been populated largely by independent advisors. So they're actually really getting up to speed in this space. And I think they're an excellent resource. They're happy to speak to managers who aren't necessarily on the consultant's buy list. They'll think outside the box. And so perhaps that's a useful starting place for pension funds to go for advice.
That's great. Thanks for that, Karen. Another question. One of the issues raised by the report is the small pool of investable opportunities. So what are the main things the project team believe will improve that? So for example, is there any opportunity to provide revenue or grant support to local authorities to develop investable opportunities? Mark, are you volunteering for that?
Yeah, I'd quite like to have a go at that, Jamie. It's I think what's interesting is something what we call, I mean, for most of my career, what I've done is I've spent my time at the bottom, and that's the foundation stone of our model, where I've been working alongside people on economic development. Now, what you will find is what I call an adjoining room problem, which is that we find local government pension fund people in one room of this hotel, and then in the next room, we will find the economic development professionals, the economic development community, people from the local authorities, combined authorities. The door is well shut between these two groups. The people who know about the investment opportunities locally are sitting in one room, and there's people in the other room, the local government pension funds, saying they don't know what opportunities exist locally. I think what we've been trying to do in this project is not to bash open the door between these two groups, but to create a common room, a third space, where people can begin to have conversations about what's possible. And I think that's what we've been trying to do in the project.
Okay.
Going back to the issue of consultation, the problem is they're not talking to each other, even though they're right next door to each other.
Sarah, do you have a comment on that?
Well, only to build on exactly what Mark said and the hope that we have this year of creating that room. So I think particularly our work on financing vehicles will be an attempt to bring together these groups to thrash out what is the role of different types of investors in building a stack that could work to drive the right capital to the right places. So just vigorous agreement and work that we will be doing to peer through the keyhole and bring people together this year.
No, don't use the word keyhole anymore. I know Jamie likes it. I don't like that. I think the idea of a common room,
adjoining rooms,
conversations is much better.
Okay. Let's move on to a question from Caroline Mason. Have you looked at the differences between urban, rural, and coastal places? Also, the model seems to put local authorities, local businesses, residents, et cetera, as passive recipients rather than active participants in the design and deployment of capital. Sarah Forster, do you want to take that one?
Sure. I mean, I think, Caroline, I mean, we were looking, I mean, it's interesting, we were looking at this from two ends of the telescope, right? One, where we were starting with the pool of institutional capital and saying, how can we shift these trillions to work and connect to communities? But absolutely seeing, as Mark said, at the foundation stone, that the people in places, this needs to be place-led. So we don't want local stakeholders to be passive recipients at all. And actually most good projects, they're not. I mean, you've got local development partners and local authorities very actively engaged. So it shouldn't be about passive recipients of capital. And also, I mean, we're absolutely, I mean, understanding that places differ, that the coastal rural areas have very different challenges to urban areas. So although we haven't contextualized that fully, of course, that is what you would need to do when you get down to the level of looking at actual investments. So yeah, I mean, that's sort of the next phase, I suppose, of this is to get to that that level of context. And I mean, Mark, I don't know if you want to add. I mean,
I don't think
geographer here.
No, I don't think in this report that's what we're saying. I think that's a misunderstanding of what we're saying. I think what we're saying is we want a place-based impact investment model that can work anywhere in this country. The really big challenge, however, is to create, to make sure that model's rolled out in areas where what we were talking about earlier, where the investable opportunities are much smaller, they're more sparse, more thin on the ground. But that's not actually, that's a challenge. That's something we can do. But the model itself, the intent of that model is it can work anywhere, but it does require different solutions and different combinations to make it happen in different places. In terms of the impact framework we have been using, is that we ourselves at the Good Economy work with 20 different investors, all interested in impact. And we have, in the work we do, have placed a huge emphasis on consulting with people on the ground, engaging with people on the ground. So this model is to be developed with the people like Caroline there and saying, that's how we're going to do it. This is what it says. It says, leave behind your computers, get out of London, right? Get on the new Great British Rail Network, right? And go and see these places, just like I've done for the past 30 years. I've been everywhere, right? And this model is something that can work everywhere. And it is something that includes people. It is not a top-down model. It's far from it. It's a decentralized model.
Okay, thanks for that, Mark. I want to, we talked about pensions and the focus, the data focus for the study was around LGPS, but the Institute has been struck by the interest in this agenda beyond pension funds. So for example, the Institute is very pleased to be partnering with Lloyd's Banking Group and a consultant known as Metro Dynamics to deliver a new project on place-based impact investing, but exploring not pensions, but the role of mainstream financial and banking institutions working in this. So what do all of you think is the relevance of the agenda beyond LGPS and beyond pensions? Sarah Teacher, do you have a thought on that?
Yeah, absolutely. I go back to the, I suppose, to Mark's common room. And when I think about, the people that I want sat at the table when we're thinking about financing vehicles, I do want to talk to social investors, the foundation community. I do want institutional investors there, and I do want banks and other key players. So I think that there are elements of this agenda that speak to anyone who is interested in driving outcomes in specified places. So yeah, I see this having a wide relevance from a multiplicity of stakeholders.
Paul, do you have a comment there?
Yeah, no, I think Sarah's right. I think we chose the local authorities because they're sort of sponsors of the community in a way that they benefit directly from those returns, not just in the pension fund, but from an improvement in their local economy, the sort of multiplier effect. But in reality, the returns on those assets were all very good for any stakeholders. And interestingly, we have seen interest from lots of overseas pension funds wanting to invest in the UK economy.
Yeah.
And they prioritize that quite significantly because the likes of Canada and Australia and the Netherlands, their own economies are too small. And so there's clearly the opportunities there. I think it comes down to applying a number of resources to find those opportunities. In Mark's words, it's the resources required to go into that kind of common room. it's not so straightforward. It's not a low-cost model. It's around one that requires finding those investment opportunities. And I think banks have got a major role in doing that, because in fact, many of them have got much stronger ties with the communities than any institutional investors, and actually could play an even bigger leadership role in finding these opportunities.
I think that's an interesting observation, Paul. But unfortunately, we're coming to the end of our allotted time. So I'd like to close here. I've got about 20 unanswered questions. Maybe we can take a crack at them after the session. But for now, I'd like to close by asking each of the Good Economy, Pensions for Purpose, and the Impact Investing Institute to offer a short but memorable thought for the audience to take away with them. Sarah Forster, can you speak for the Good Economy?
Oh, thank you, Jamie. Well, yeah, I am going to speak to Good Economy. I'm going to speak again personal. I mean, I actually I spent 20 years working on development in Africa and post-conflict countries, and I came back to the UK 20 years ago thinking, you know, how can we be advising on development in these poorer countries when we haven't actually fixed our own problems in Britain? We have such entrenched poverty and place-based inequality, and yet we have the money. So I actually think this isn't about the money ultimately. Yes, it is, but it's more, you know, as Mark would say, it's about mindsets, it's about culture, it's about wanting to make it happen. So, you know, I think we see this report as a call to action. We hope it's the beginning of a movement to really bring people together. You know, we have a lot of dissonance in our work. I used to come from the world of community investment. I now work with the City of London that I ran away from in my 20s. You know, we want to connect and build trust. And we absolutely think, you know, even with a small allocation of the trillions, it could make a huge difference. So we're hoping this will move us to an action agenda with everybody.
Thank you, Sarah. Karen, a parting thought?
So when we've spoken to impact managers about what's been the main challenge that they've faced when investing impactfully, the most common reason that was cited was the challenge of finding a cornerstone investor. So my call to action is to the consultants and to investors just to be more open-minded about cornerstone investing and its importance, and recognizing the role that you could play if you were prepared to take that leap of faith.
That's excellent, Karen. Thank you for that. And Sarah, teacher?
My one is a practical one. So we urge you to download, read, and share the report. But more than that, we'd love you to join with us in the next chapter of work. So I've put my details in the chat. If you're interested to help raise awareness, build competency, reporting, origination, financing vehicles, we want to hear from you. So please be in touch. Thank you.
Thank you, Sarah. And thank you for those insights. I think you've really given people in the audience some really thought-provoking things to consider and some action items. So I'd like to thank Sarah Forster, Mark Hepworth, Paul Stanworth, Sarah Teacher, and Karen Shackleton for their insights and participation this afternoon. And finally, I'd like to thank you, the audience, for making time for us today and engaging in the emerging and increasingly relevant area of place-based impact investing. Thank you all.